Bank crisis is not over. Bankruptcies are increasing, and I'm going to show you the reality the media will not. In this video, we're going to look at the truth. It's going to be hard. It's like Buckley's. The medicine kind of tastes bad, but you got to deal with it because that's how we're going to advance. That's how we're going to know the information we have to so that we can make the informed choices, the informed decisions that unfortunately sometimes are difficult. That's the circumstance we are in today. You can look at what's happening in the markets, you can start to readjust your portfolios and everything that you've got, and I'm going to bring you what you need to know. Sound good? Let's begin. First things first, the Federal Reserve, they have been going through this back and forth. Are we going to increase? Are we not going to increase? Last meeting, they did not increase. But in this case here, the meeting minutes came through and it suggested that while most of the members thought it was wise to pause at this point, they do believe that more increases are needed. That means potentially 2 more increases here in 2023. Now, why is that significant? Okay, so what? Another 2 increases. It means that the actual cuts would have to come after that, obviously. And so we can expect that these cuts that the market's been pricing in, the market's been waiting for a while, are not coming anytime soon. What we have here is a continuation of the trend. That means potentially more bank failures. That means more of the bankruptcies that are occurring. That means commercial real estate has additional pressure on it. And all of the actions that we've seen in this cycle are going to be let's just say magnified the longer this goes on. The more we've got to deal with in that length of time, the harder it's going to be to reverse. And as a result of that, we are going to see cutting of interest rates at some point, there's no question. But when that happens, it's going to happen rapidly. And that rapid decline is going to create an inflationary spiral like we've never seen. You've got to understand this. If you are not right now prepared for mega inflation, then you are in a big world of hurt coming right for you. Let's continue. I'm going to show you why that's the case today. Okay, you got to pay attention to all this. It's so key. You could see that this is, by the way, from Real Investment Advice. Really good resource, and I've always spoken highly of them. It was an interesting take. So the suggestion here is that 2 to 3% on the Fed funds rate by next June. That's what they're saying. And why? Well, they make the case showing you the previous examples through the different cycles and how they react. The Fed reacted in previous times. And basically, they're going to cut hard and fast. And they've done that all of the other previous cycles. So this would likely be the same. In fact, even faster. If anything, they increased at a very fast pace. So we can expect the cuts to come at a very fast pace. Now, the market is just hold on to those stocks, hold on to those stocks. If we can just hold on long enough, eventually they're going to cut and then stocks will go up. But it isn't necessarily the case. Not all stocks are going to perform well during those periods. If there is a recession, if there's a slowdown, who is affected? There's a lot of questions that are not simply they cut interest rates and all stocks are going to go up. It really doesn't work like that. And so 2 to 3% Fed funds rate by next year. What do you think? Let me know in the comments below. I do trust Real Investment Advice generally in what they talk about, but is this accurate? You let me know. Here we go. Seeing that the global central banks are set to diverge on rates as stubborn inflation stalks the Fed and the ECB. So depending on where you look around the world, you can see it for yourself. The rate will be higher by the end of 2023, supposedly anyway, for Canada, the US, Australia, other places. And you could see lower in some areas, whether that's China, Brazil, and places that have maybe what they consider to be either they need to stimulate in those places like China, or maybe some would consider that they've done enough. I'm not so sure for most places, but in the case of China, they really need to stimulate, and that's going to present itself with an issue right through the remainder of the year, because if you're stimulating on top of this, you are creating a big problem. That's where we're at today. So you could see the conundrum that central banks are in, and it's going to be a wild year, let me tell you. Real wages have fallen behind more this time than in the past. So you can see the historical trend, that's the darker blue line, and then 22 to 23 being the lighter line, and you will see the difference showing us the median change in real wages during the disinflation episodes. And what I would have to say is when you look at inflation being this high for this long, it wasn't expected at all. All of the financial analysts said absolutely not. We had team transitory, and even the YouTubers were repeating that. I saw it all over Twitter. They can't hide it unless they deleted those tweets. But we know what's going on. You and I know what's going on. That's why you're here. The news, which is going to give you some of this information, is not going to spell it out in the way that I do. We are connecting the dots. That's why you're here, to make sense of all this nonsense and hocus pocus. One of the commenters said, take the hocus pocus and bring it into focus. I don't know if that's going to be my new line, but I think it's important to actually see what's happening. You've got central banks that are reacting and overreacting because it didn't react soon enough. That's the whole point. That's the whole problem. And now they're essentially, claiming that they're going to be strong. They're trying to actually bring inflation down. You need higher interest rates. They're not going to do that, at least not significantly. Legendary investor Jeremy Grantham says the stock market has a 70% chance of crashing, and it could be an epic burst like the 1929 crisis. We have seen him say this before. It's not anything new. He was very accurate in previous cycles. There's no question about it. But, I think that we have to wait and see. When we look at these type of predictions, and we could focus on that, and, I could create titles that would be so fantastic to get the clicks. I think it's important to note what this is all about. And it's that when you create too much debt, you run into a very big problem. That's the real story. Debt, in this expansionary phase, is met with crisis eventually. And that's what we're dealing with. It's not about how, the percentage that the stock market goes down and all these things. It's really about understanding the debt cycles. And Ray Dalio does talk about this quite a bit. And I think we should be focusing on that, not necessarily any particular prediction, because in the end, usually people are wrong. You could see it for yourself. American manufacturing just slumped to its lowest level in 3 years. Jefferies says the sector is still mired in recession. You've got a big problem with manufacturing because it's not coming home. I talked about this with one of the people that were commenting. They said, force them to come back home. Absolutely. We look at Apple. Apple manufactures their desktop computer in Texas, I believe. And it's a high-end computer. There's no question about it. It's not a normal PC. It's $10,000. Would you like to pay what I would consider an unreasonable sum for most people's computers? Would you want to do that? Most people say, I'm not going to spend $10,000 on a computer. Well, you're going to pay a massive premium on your everything if you manufacture it in the US. And we'll say, well, that's what you got to do. That's going to really actually slow down the economy, because part of that actually takes place in the United States. The places that are selling them, the places that are repairing them, the places that are, dealing with the packaging and all the shipping and everything. So by selling less, even if it's manufactured somewhere else, you're actually hurting your own economy. So there's, it's not just one-sided. I need to make that clear, okay? Subprime auto bondholders face possible first hit in decades. Holders of riskiest parts of 3 ABS asset-backed security deals may see losses. Consumers are not repaying their debt after lenders shut their doors. Do you not think that's a problem here? Do you not see a crisis? Because people were taking on a ridiculous amount of debt for their auto loans. I mean, it's unbelievable to see that, right? Well, it's not just there, though. Bankruptcies are rising. U.S. new bankruptcy cases, Chapter 11 business filings. You could see how that is increasing. Bankruptcy filings, just showing us both of these have been increasing over the last while. And, compared to what we had saw back in 2008, we're still lower. There is no question, but it's rising as interest rates not only, excuse me, not only stay high, but stay high for longer, well, that just only makes it worse. Rising bankruptcies point to greater charge-off rates as well. We could see that, and we will note in the coming months what happens. I think there's going to be a lot of problems for a lot of these companies. Canada adds guidelines for banks to prevent mortgage defaults, essentially forcing the banks to take it easy on these people because they know specifically that they can't afford their mortgages. These things are coming due in 2023, in 2024. Okay, I just saw one property that was selling at auction. You don't see that in Canada a lot. In the US, foreclosures are so common. But in Canada, those type of things don't happen. The bank takes ownership, and then probably based on the fact that they were building a new home, the rates went up much more than they thought. And that's it. That's the way it goes, right? Those people lost their home. I mean, it's unfortunate, but that's the circumstances that we're dealing with. And the government's trying to step in and do everything they can. Instead of just keeping interest rates elevated for a period, it's going to hurt. But in the end, you're going to have less problem. No, they don't want to do that. Okay, here we go. Payrolls may overstate U.S. job gains, some Fed officials suggest. They pointed to other weaker data at the last month's Fed meeting. Almost all policymakers still project more Fed rate hikes. Basically, the job market, it depends on the data that you look at. If you look at the U3 unemployment rate, that's one thing. The jobs numbers is one. If you look at seasonally adjusted numbers, or what about non-seasonally adjusted numbers? I mean, it's a web, but you got to understand that things aren't as rosy as they make it seem. I think that's really the point I wanted to highlight. Canada port strike enters the fifth day with talks deadlock, threatening the economy. I noted that UPS may actually end up going on strike. They're going back and forth. So shipping is a very big issue, of course, especially in today's day and age where, I need a bag of beans and I order it online. I need some toilet paper. I ordered it online. That's just the way it goes. So we've got these things that are being added up right now. Employees want more money. Businesses need more profit. You've got inflation rates that are simply out of control. All of them converging. The bank crisis still going on underneath it. And what is the end of all of this? Apparently, according to the Federal Reserve, 2 more rate increases. So watch as this continues. I hope that we connect some of these dots today, and that will empower you to make better decisions. You let me know what you want to see in the comments below. I think it's important to understand different asset classes, different investments, because there's going to be a point at which you might want to get into one of these assets. Maybe that's today. Maybe that's, you anticipate a big dip and you want to jump in. Real estate is one that I talk about. I talk about all the 4 different asset classes, but real estate is one. And I want you to check this video out, why the 4 reasons of why you can benefit from real estate. 4 big reasons. Click this video. I'll see you there.